The financial institutions deliberately suppress the price of silver to $61.96. Their objective is to convince you that the recent upward movement in silver prices is over, and that silver is merely a speculative asset that has now lost its value. This is a deliberate deception, a significant omission of crucial information that borders on criminal negligence. While you were distracted by the fluctuating market data yesterday, and as automated trading systems were offloading paper silver contracts in New York, a monumental development occurred in South Korea that renders the current silver price utterly irrelevant. This event fundamentally alters the chemistry underpinning the global energy transformation. Samsung SDI, a global leader in battery manufacturing, has quietly revealed the technical specifications for its upcoming solid-state battery production facility. The mainstream media is hailing this as a monumental advancement in battery technology, focusing on impressive metrics like a 900-mile driving range and 9-minute charging times. However, they are overlooking the single most critical detail, a detail that Wall Street has failed to account for, and one that mining corporations have not adequately prepared for. This overlooked factor renders the projected 1.1 billion ounce deficit in silver supply practically insignificant. The secret component in Samsung's revolutionary new battery is not lithium, nor cobalt, nor nickel. It is silver, and it's not present in negligible quantities. This innovation signifies a substantial, structural increase in the per-vehicle demand for silver. This is a technology that elevates silver from a precious commodity to a strategically vital energy metal. Over the course of this four-part analysis, I will expose the silver bomb that Samsung has just detonated within the global supply chain. I will meticulously detail the chemistry behind the silver-carbon anode. I will perform the calculations that international energy agencies refuse to publish, calculations that definitively prove there is insufficient silver on Earth to electrify the global vehicle fleet using this groundbreaking technology. Furthermore, I will demonstrate why Friday's price decline to $62 was not a market crash, but rather your final opportunity to acquire silver before the automotive industry confronts the catastrophic miscalculation they have made. The financial institutions are engaged in a game of paper manipulation, while Samsung is operating within the immutable laws of physics. Physics, as history has shown, always prevails. This is the narrative of the silver-carbon revolution. To grasp the magnitude of this news as an extinction-level event for silver availability, one must understand a fundamental principle of chemistry, which I will explain in a simplified manner. For the past 3 decades, the world has relied on lithium-ion batteries. The devices you use daily, your smartphone, your laptop, and even the electric vehicles in your garage, all utilize lithium-ion batteries with liquid electrolytes. While effective, these batteries possess a critical vulnerability: the dendrite. During rapid charging or excessive charging cycles, lithium ions within the battery can form needle-like crystal structures known as dendrites. These formations grow like intricate root systems inside the battery. Eventually, they breach the separator, the barrier between the anode and the cathode, leading to a short circuit, thermal runaway, and potentially a fire. This inherent flaw is why electric vehicles require lengthy charging times of 45 minutes. Slow charging is necessary to mitigate dendrite formation. It is also the reason for their propensity to catch fire and their reduced range during colder months. The ultimate objective has consistently been the development of a solid-state battery, a battery devoid of liquid electrolytes, eliminating fire risks, enabling instantaneous charging, and doubling driving range. Numerous companies from Toyota to Volkswagen have been pursuing this goal for over a decade, but all have encountered insurmountable obstacles. The primary challenge has been preventing dendrite formation on the anode. Traditional graphite anodes proved ineffective, silicon anodes exhibited excessive expansion, and pure lithium metal anodes were inherently unstable. However, researchers at Samsung SDI have reportedly discovered the solution. They found that by applying a nanomposite layer of a specific element, the dendrite problem could be entirely resolved. This innovative layer allows lithium ions to traverse freely while effectively halting dendrite growth, resulting in a stable and highly conductive medium. That crucial element is silver. More precisely, it is a silver-carbon nanocomposite layer. This is not speculative. It is scientifically validated and published. Samsung's prototype battery cells incorporate a thin layer of silver blended with carbon to precisely regulate lithium deposition. The silver acts as a matrix for the lithium ions, ensuring their even distribution and preventing the formation of disruptive spikes. This advancement allows for the creation of batteries that are smaller, lighter, faster, and significantly safer. However, there is a substantial caveat. This technology requires a considerable amount of silver, not merely trace amounts, but grams per unit. For the first time in history, silver is not just being utilized for its exceptional conductivity. It is functioning as an active material within the electrochemical energy storage process, becoming an integral component of the battery's fundamental structure. The automotive industry is poised to implement this technology on a massive scale, deploying it in millions of vehicles. Do you perceive the emerging problem? You might be thinking, so they use a bit of silver. What's the big deal? Cars already contain silver. Let's put this into perspective. A conventional internal combustion engine vehicle currently utilizes approximately 15 to 20 grams of silver, found in components such as window switches, seat motors, defroster elements, and the engine control unit. An electric vehicle consumes more, around 30 to 50 grams, incorporated into inverters, battery management systems, and high-voltage cabling. This increase in silver usage in EVs is already exerting pressure on the market, contributing to the existing deficit of 1.1 billion ounces. However, the advent of solid-state batteries fundamentally alters this equation. We are no longer discussing small switches. We are talking about coating the anode of every cell within a 1,000-pound battery pack. Preliminary assessments derived from Samsung's research papers suggest silver loading ranging from 5 to 10 grams per kilogram of anode material. Some more ambitious projections indicate that high-performance, long-range battery packs could require as much as 0.5 to 1 kilogram of silver per vehicle. Let us adopt a highly conservative estimate, assuming an additional 50 grams of silver per car. This would elevate the total silver content in an electric vehicle to approximately 100 grams. With 90 million vehicles produced globally each year, if merely 10% of these transition to solid-state batteries, that translates to 9 million vehicles. 9 million vehicles multiplied by 100 grams of silver equals 900 million grams, or roughly 29 million ounces of new annual silver demand. This figure might appear manageable. However, this is based on a modest 10% adoption rate and conservative silver loading. What if adoption reaches 50%? What if the silver content per car is actually 200 grams? If manufacturers like Toyota, Samsung, and Volkswagen achieve their stated goals of mass-producing solid-state electric vehicles by 2027 or 2028, automotive demand for silver could surge from 90 million ounces annually to 200 or 300 million ounces per year. Where will this additional 200 million ounces originate? Will it come from existing above-ground stockpiles? These stockpiles currently hold only 30 million ounces in registered reserves. Will it come from mining operations? Global silver mine production remains stagnant at 830 million ounces. This single technological innovation, the silver carbon anode, possesses the potential to consume 25 to 35% of the entire global mine supply solely for electric vehicle batteries. This leaves no silver for solar panels, no silver for electronic devices, no silver for jewelry, and critically, no silver for the general public. And Samsung has just confirmed the commencement of its pilot production line, indicating an accelerated timeline. This is no longer a future concern, it is an immediate reality. While financial institutions were driving down the silver price to $61.50 on Friday, Samsung's procurement specialists were likely securing long-term supply agreements with mining companies. They understand the underlying economics. Without guaranteed silver supply, their multi-billion-dollar battery manufacturing facilities become worthless. This shift signifies a fundamental alteration in the nature of demand. Historically, silver has been considered an industrial additive, a minor component used in circuit boards or light switches. Because the quantities were so small, price fluctuations had minimal impact. Even if silver increased from $20 to $100 an ounce, the cost of an iPhone would only rise by 50 cents, a negligible increase for Apple. However, with solid-state batteries, silver transitions to a structural component, representing a significant line item in the bill of materials. If a battery pack requires 500 grams of silver at $60 an ounce, that equates to $1,000 worth of silver per vehicle. At $100 an ounce, this figure escalates to $1,600. This prospect deeply concerns automotive manufacturers, who operate on extremely thin profit margins. A cost increase of $600 per vehicle could devastate their profitability. Consequently, their strategy will likely involve cost reduction measures. They will attempt to minimize silver usage, engineer it out where possible, and potentially utilize silver-coated carbon instead of pure silver powder. However, the fundamental challenge remains. Chemistry is immutable. One cannot circumvent the principles of electron behavior. Reducing the silver content would reintroduce the dendrite problem, leading to the very safety issues that solid-state batteries are designed to solve. Would you purchase a silver-enhanced battery if you knew there was a 5% chance of it exploding in your garage? Unlikely. Samsung and Toyota are acutely aware of this dilemma. They cannot reduce the silver content without compromising safety. They are, therefore, constrained by the fundamental laws of chemistry. This renders demand inelastic. We have observed a similar phenomenon with solar panels, and now we are witnessing it with electric vehicles. Two major global industries, energy and transportation, are concurrently adopting technologies that necessitate substantial quantities of silver. This is occurring against a backdrop of a supply chain that has suffered from a decade of underinvestment. Friday's price reduction to $61.50 is almost laughable in this context. We are facing a future where silver will be as indispensable to the global economy as oil. Imagine if the world experienced an oil shortage and the price plummeted to $2 a barrel. Would you panic and sell your fuel, or would you fill every available container? Why is this critical information not being disseminated on financial news channels like CNBC? Why are publications like Bloomberg focusing on lithium oversupply while ignoring the impending silver squeeze? The prevailing market narrative has not yet caught up with scientific innovation. Wall Street analysts are often remiss, relying on outdated data from 2020 and assuming that electric vehicles are solely dependent on lithium and nickel. They continue to categorize silver as a legacy metal primarily used in mirrors and cutlery, neglecting to review the technical white papers published by Samsung SDI or the patent filings from companies like QuantumScape and Toyota. Had they done so, they would have repeatedly encountered the term silver. This informational disparity represents a significant advantage for those who are aware. Currently, on this Saturday morning, the market is mispricing silver because it operates under the assumption of linear demand growth, projecting only a 2% annual increase. It fails to recognize the quantum leap in demand that solid-state batteries represent. A similar scenario unfolded with palladium in the early 2000s. Automotive manufacturers transitioned to using palladium in catalytic converters, a development that largely went unnoticed. Subsequently, demand experienced an explosive surge, propelling palladium prices from $200 to $3,000. Analysts were a decade behind. We are witnessing an analogous situation with silver. The silver bomb has been detonated within research and development laboratories. The resulting shockwave has yet to impact the price charts, but its arrival is inevitable. When Samsung officially introduces the first mass-market vehicle equipped with this battery, and the world realizes that a single luxury sedan contains 20 ounces of silver, the ensuing panic buying will not originate from online forums, but from automotive giants like Ford, General Motors, and BMW. And they will not be purchasing at $61.50. We have established the technological feasibility of the silver carbon anode. It is demonstrably superior, and its widespread adoption is imminent. The critical question that now demands an answer is whether there will be sufficient silver to meet the demand if every automotive company transitions to this technology. Considering the continued growth in solar energy and sustained investment demand, do the projected figures add up? In the second part of this in-depth analysis, I will present the extinction equation. I will precisely calculate how rapidly global silver reserves will be depleted under the Samsung scenario. I will debunk the myth of silver recycling and explain why it will not provide a solution. Furthermore, I will draw parallels to the price spike of 1980 to illustrate why a silver price of $100 is a conservative projection. Friday's price decline was a fortuitous event, an opportunity presented by the market to get ahead of the most significant industrial shift in history. While financial institutions are fixated on weekly price charts, your focus should be on the periodic table. Do not go anywhere, as the financial implications become even more alarming in Part 2. If you have just viewed Part 1, you are now privy to the secret that Wall Street is deliberately overlooking. You understand that the solid-state battery revolution is not solely fueled by lithium. It is powered by a silver carbon anode. You are aware that Samsung and Toyota are preparing to integrate vast quantities of silver into the automotive supply chain to address the dendrite issue and prevent battery fires. Now, we must examine the ramifications of this development. It is one thing to predict an increase in demand. It is an entirely different matter to scrutinize the geological realities of our planet and conclude that we are quite literally incapable of meeting that demand. In Part 2, we will perform the calculations that the International Energy Agency is too apprehensive to publish. We will confront the extinction equation. We will dissect the myth of recycling and explain its inadequacy. And we will elucidate why Friday's price of $61.50 is mathematically unsustainable. In a world where vehicles consume silver, this is where the practical implications become undeniable, or rather, where silver meets the anode. Let us commence with the baseline scenario, representing the current global market conditions before the full impact of the Samsung silver development is realized. Total annual global mine production stands at 830 million ounces. Annual recycling contributions amount to 180 million ounces. This results in a total annual supply of 1,030 million ounces. Now, let us examine demand prior to the widespread adoption of solid-state batteries. Industrial demand, encompassing solar energy and electronics, accounts for 600 million ounces. Demand for jewelry and silverware totals 200 million ounces. Investment demand, in the form of coins and bars, reaches 250 million ounces. We are already operating at a deficit, depleting existing reserves by approximately 50 to 100 million ounces annually, simply to maintain current operations. Now let us introduce the Samsung scenario. Let us assume a moderate adoption rate for solid-state batteries, projecting that by 2028, 20% of new electric vehicles will incorporate this technology, with a conservative silver loading of 50 grams per vehicle. Global vehicle production currently stands at 190 million units. Assuming electric vehicles constitute 40% of this market, that equates to 36 million EVs. If 20% of these EVs utilize solid-state batteries, that translates to 7.2 million vehicles. 7.2 million vehicles multiplied by 100 grams per vehicle, assuming an approximate conversion of 1.6 ounces per 100 grams, equals 11.5 million ounces of silver. 11.5 million ounces is a significant amount, but it is not world-altering in isolation. However, this calculation is based on a small, efficient vehicle. Consider a Ford F-150 Lightning or a Cybertruck. These vehicles possess substantially larger battery packs and may require 500 grams of silver, not 50. If the average silver loading across the entire EV fleet more closely approximates 200 grams and adoption reaches 50% of EVs, let us re-evaluate the figures. 18 million vehicles, 50% of 36 million EVs, multiplied by 200 grams per vehicle equals 115 million ounces of new demand. This figure is equivalent to the entire annual silver production of Peru, or the instantaneous emergence of an entirely new solar industry. Where will this additional 115 million ounces be sourced? The market is already experiencing a deficit, and available stockpiles are depleted. There are only two primary avenues for this supply to materialize. Firstly, significant price escalation, driving the price to a level where demand for jewelry and silverware diminishes. Secondly, the depletion of investment holdings, where the price becomes so high that individuals choose to sell their silver coins to manufacturers. This constitutes the extinction equation. Total available silver supply is insufficient to meet the combined demand from solar energy, electronics, and solid-state batteries. This calculation does not even account for investment demand. The industrial demand alone poses a threat of consuming 100% of the annual mine supply. If this occurs, silver will cease to be a monetary metal accessible to the public and will instead become a critical strategic material exclusively reserved for industrial applications, effectively becoming unobtainium. However, skeptics will interject. We will simply recycle. They argue that silver will be recovered from old vehicles. This is the recycling myth, a dangerous misconception that fosters a false sense of security among policymakers. The reality of silver recycling is starkly different. Gold, due to its concentrated nature, is recycled at a rate of nearly 90%. Silver, conversely, is recycled at a rate of less than 20%. This is attributed to its dispersion. Silver is ubiquitously distributed in microscopic quantities across billions of devices. Your smartphone contains approximately 0.1 grams, your laptop around 0.5 grams, and solar panels feature a thin film. Missile guidance chips incorporate a nanoscale layer. The cost and energy expenditure required to extract such minute quantities of silver often exceed the value of the metal itself. Consequently, this dispersed silver often ends up in landfills, effectively burying billions of ounces back into the earth in an irretrievable form. Now consider the solid-state battery. While it contains a greater proportion of silver, one does not typically recycle a car battery within a year. Recycling occurs after approximately 15 years. The silver integrated into a Samsung solid-state battery in 2026 will remain sequestered until 2041, effectively removing it from the available supply pool for an entire generation. Therefore, the anticipated wave of recycling will not materialize in time to alleviate the projected shortage during the 2020s. The deficit is structural, consumption is destructive, and sequestration is long-term. This indicates that the only viable solution to the Samsung scenario is increased mining. But can we simply extract more silver? If silver reaches $100 per ounce, surely mining companies will flood the market with supply, correct? This is where we encounter the geological wall. One cannot magically create a silver mine. The process from discovery to production typically spans 10 to 15 years. Even if a significant new deposit were discovered today, it would not yield a single ounce until 2035. However, Samsung requires silver now, as does Tesla. Furthermore, existing mines are facing depletion. The ore grades have drastically declined. In 2005, a high-grade mine might yield 15 ounces of silver per ton of ore. Today, a comparable mine might produce only 4 ounces per ton. This necessitates the excavation of 4 times more rock to obtain the same quantity of silver, leading to increased consumption of diesel, water, and labor, making mining exponentially more challenging and expensive. We must also consider the political landscape. Mexico, a major silver producer accounting for 25% of global output, has halted the issuance of new open-pit mining permits. Peru faces persistent strikes and protests. Russia is subject to international sanctions. Consequently, at the precise moment when the silver-carbon anode demands an additional 100 million ounces annually, global mining supply is projected to shrink. This presents a pincer movement. Demand is escalating exponentially, while supply is contracting, and available inventory buffers have evaporated. There is no pressure relief valve, no elasticity in the system. The only factor that can adjust is the price. This leads to a perplexing paradox, the electric vehicle paradox. Governments worldwide have mandated the cessation of internal combustion engine vehicle production and have legally compelled the transition to electric vehicles. They are subsidizing battery manufacturing facilities, but have overlooked a crucial element, the periodic table. If silver prices surge to $200 per ounce, the cost of solid-state batteries will skyrocket, rendering electric vehicles unaffordable for the average consumer and stalling the transition. However, governments cannot permit this transition to falter, having staked their political credibility on achieving net zero emissions. What course of action will they pursue? They will either subsidize silver or seize it. We have previously discussed the Defense Production Act. This is precisely where its implications become tangible. If General Motors informs the White House that they cannot fulfill mandated vehicle production due to a lack of silver, the White House will not simply acquiesce. Instead, it will declare its intention to secure the necessary silver. Silver will be designated a critical strategic material, and industrial allocation will be prioritized over retail investment. It is conceivable that the sale of silver coins to the public could be prohibited to divert the metal to battery factories. This represents a nightmarish scenario for individuals who have not yet accumulated silver holdings. They will not be competing against a high price. They will be competing against a government mandate. Samsung is not merely a company operating in South Korea. It is a significant economic entity. The South Korean government will spare no effort to ensure Samsung's access to silver. Similarly, the United States government will act to secure supply for Tesla. The silver-carbon anode elevates silver to the status of a national security concern, and national security invariably supersedes free market principles. Consequently, we have the technology, we have the mathematical projections, and the conclusion is irrefutable. A structural and insurmountable shortage is on the horizon. But how does one capitalize on this impending situation? Friday's decline to $61.50 has instilled fear in many less committed investors. However, for those who comprehend the Samsung scenario, this price point is a negligible error in market valuation. In part 3 of this series, we will shift our focus to the solution. I will identify the mining stocks that are optimally positioned to benefit from this burgeoning demand. I will explain why numismatics may represent a deceptive investment, and I will outline a strategic exit plan for when this market phenomenon reaches its zenith. The technology is real, the impending shortage is real, and Friday's price dip is a manufactured illusion. Do not allow these market manipulations to deter you. This revolution is merely in its nascent stages. Should you have viewed the initial and subsequent installments, you now possess insights that a vast majority on Wall Street are overlooking. You've grasped that the forthcoming revolution in solid-state batteries necessitates a silver-carbon anode. You're aware that this singular innovation could necessitate the consumption of 115 million ounces of newly mined silver each year. Furthermore, you comprehend that geological constraints preclude mines from ramping up production sufficiently to satisfy this burgeoning demand. Thus, here we stand on Saturday, December 13th. The price of silver concluded yesterday's trading at $6.50. The market is fraught with apprehension. Retail investors are in a state of panic. Yet you remain composed, cognizant that this price decline represents a mere anomaly, a temporary mispricing preceding the inevitable impact of the Samsung development on market indicators. However, knowledge devoid of action is of no consequence. How then do you position yourself to capitalize on the impending silver surge? Do you simply acquire bullion coins? Do you invest in mining corporations? Do you opt for exchange-traded funds? In the third segment, I shall furnish you with a strategic roadmap. I will delineate the three primary avenues for engaging with the silver market. I will expose the fallacy of investing in semi-numismatic items during a period of intense industrial demand, and I will elucidate why an unhedged mining entity is the sole publicly traded company you should currently hold. The automotive sector is poised for a frantic acquisition spree. You must preempt their actions. Here's the methodology. The first avenue, physical precious metal. This serves as your safeguard, your bastion of wealth preservation. However, in an era of unprecedented industrial demand, the criteria for investment undergo a complete transformation. For years, purveyors have been promoting semi-numismatic items, collectible coins, limited edition prints, and even silver-themed memorabilia. They've espoused the notion that these items retain value more effectively. In conventional market conditions, this might hold true. Yet we are not navigating conventional territory. We are entering a vacuum of industrial supply. When a company like Samsung requires silver for battery production, the presence of a Darth Vader engraving or a prestigious MS-70 grading becomes utterly irrelevant. Their singular focus is on the elemental substance. They require raw silver to be processed into nanopowder for anode materials. Consequently, in a genuine scarcity, the premium attached to collectible items will diminish considerably relative to the spot price. The reason for this is straightforward. The industrial purchaser establishes the baseline value. Should the spot price ascend to $100, the melt value of your coin will be $100. However, no one will offer you $150 for its collectible status when the global market is desperately seeking the metal itself. The recommended strategy is to cease paying for artistic embellishments and commence paying for weight. Within the context of the Samsung initiative, ounces are paramount. A 100-ounce industrial bar emerges as the superior asset. The rationale is threefold. Firstly, a reduced premium. You acquire more silver for your capital outlay today. Secondly, liquidity. Should you need to divest to an industrial buyer or a refiner, they will favor bars. Thirdly, density. It is more efficient to store 1,000 ounces in the form of bars than in 1,000 tubes of individual coins. If your current acquisition price is $6.50, disregard ostentatious items. Procure the most economical and widely recognized government-issued or corporate bullion you can identify. Consider maple leafs, eagles, 100-ounce bars or 10-ounce bars. Your objective is to amass the greatest quantity of silver by weight before Samsung depletes available inventories. The second avenue, mining equities. This is where the potential for transformative wealth creation resides, provided you select the correct investment. I indicated in the preceding installment that mining companies represent a strategic reserve. However, a pitfall exists within this domain as well, commonly referred to as hedging. Envision a mining enterprise named Loser Gold Corp. Last year, when silver was priced at $25, they harbored anxieties and sought to guarantee profitability. Consequently, they entered into an agreement to sell 50% of their future output at $30 per ounce for the subsequent 3 years. Presently, silver commands a price of $61.50. Loser Gold Corp. is compelled to sell its silver at $30, with the excess $31.50 accruing to the financial institution. Their stock value will exhibit negligible appreciation, as they have effectively missed the market's upward trajectory. Now consider Winter Silver, Inc. This company foresaw the impending shortage and deliberately refrained from hedging. They sell every ounce of their production at the prevailing spot price. Today they are selling at $61.50 per ounce. Should silver reach $100, they will transact at that price. This situation engenders operational leverage. If their extraction cost is $20 per ounce at a $30 silver price, they realize a profit of $10. At a $100 silver price, their profit escalates to $80. The price has tripled, while profits have multiplied eightfold. Consequently, their stock valuation is likely to experience a tenfold or even 20-fold increase. The recommended strategy is to rigorously scrutinize the mining companies in which you hold investments. Review their quarterly reports and locate the section pertaining to hedging and derivatives. If forward sales contracts are evident, divest your holdings immediately. You require 100% unhedged exposure. Furthermore, prioritize primary silver mining operations. The majority of silver production is a byproduct of lead or zinc extraction. Consequently, those entities exhibit minimal concern regarding silver price fluctuations, viewing it merely as an ancillary gain. Your focus should be on companies whose existence and prosperity are intrinsically tied to silver. The Samsung development is poised to trigger a bidding war for these companies. Battery manufacturers may commence acquiring equity stakes in mining firms to secure their supply chains. Should Samsung purchase 10% of a junior mining company, that entity's stock could skyrocket instantaneously. The third avenue, geographical location. We touched upon this previously, but its significance to the narrative of battery metals cannot be overstated. Governments in the United States and the European Union have enacted legislation mandating that battery materials be sourced from allied nations to qualify for electric vehicle tax credits. If an automotive manufacturer procures silver from Russia or China, they forfeit the tax credit. Conversely, sourcing from a mine in Nevada or Ontario yields substantial tax benefits. This cultivates a bifurcated market for silver mining entities, categorizing them as producers of clean versus dirty silver. Clean silver will command a premium. Companies such as Samsung and Tesla will allocate higher prices for silver originating from secure jurisdictions, thereby ensuring the legality of their supply chains. The inherent risk lies in Latin America. Mexico and Peru are principal silver-producing nations. However, as prices approach $100, the temptation for their governments to nationalize mines becomes considerable. We are already witnessing labor disputes and blockades in these regions. The recommended strategy involves orienting your portfolio towards Tier 1 jurisdictions, such as Canada, the United States, and Australia. These nations possess stable legal frameworks, and crucially, are strategic partners within the battery supply chain. A mine located in Idaho holds 5 times the strategic value to a company like Tesla compared to a mine in Bolivia, even if the silver content is identical. This is because the Idaho mine offers security. If you hold mining stocks, examine their operational map. If 100% of their assets are situated in a country with a history of asset seizure, you are holding a precarious investment. Finally, let us address the exit strategy. In my prior communication, I advised against liquidating for fiat currency, yet it is imperative to eventually transition away from the battery-related trade. Technological advancements occur at a rapid pace. Presently, the silver carbon anode represents the vanguard technology, expected to drive market demand for the next 5 to 10 years. However, by the year 2035, it is conceivable that graphene anodes, requiring no silver, might be developed, or perhaps sodium-based batteries could render lithium-ion obsolete. Commodity supercycles propelled by technological innovation typically span 7 to 10 years. Consider the trajectory of uranium in the 2000s or cobalt in 2017. We are currently at the inception of the silver battery cycle. You possess a window of opportunity. The demand surge is just commencing. Friday's closing price of $6.50 signifies the starting line. Nevertheless, unwavering vigilance is paramount. Should you encounter headlines 5 years hence announcing Toyota's development of a silver-free solid-state battery, that will serve as your definitive signal. At that juncture, the structural deficit may abate. However, for the ensuing decade, the underlying economic realities are firmly established. Factories currently under construction are engineered to accommodate silver and cannot readily adapt for at least 2 product generations. Consequently, for the foreseeable future, the demand from Samsung will act as a foundational support for the silver price. The recommended strategy is to capitalize on the initial phase of growth, accumulate assets presently, endure the speculative fervor, and then consider transitioning to land or other assets as market euphoria reaches its zenith. Avoid becoming permanently attached to this specific trade. Instead, embrace the broader economic trends and engage tactically with technological developments. Therefore, you are now equipped with the strategic framework: physical bars, prioritizing weight over artistic value; unhedged mining operations, leveraging market dynamics, and focusing on secure geographical locations. However, one immediate challenge remains. As Sunday night approaches, we are currently experiencing the weekend price gap. The valuation is frozen at $6.50. However, the news concerning Samsung, the reports of refinery disruptions, and the details of failed margin calls are circulating widely. When the Asian markets commence trading tomorrow evening, we will witness the market's reaction to Friday's price decline. Will it accept the lower valuation, or will it target short sellers and propel the price back to $64? In the fourth and final installment of this series, I will provide my precise forecast for the Sunday night opening. I will elucidate the arbitrage mechanism operating through Shanghai, which will exert upward pressure on the price. And I will conclude with a final message regarding the psychological warfare you are likely to confront in the coming week. The Samsung catalyst has been deployed. Its repercussions will be felt on Monday. The era of Samsung is upon us. Do not miss the concluding segment. We have arrived at the conclusion. If you have followed me throughout this comprehensive analysis, you now possess a complete understanding of the silver surge. You comprehend the underlying technology. You grasp the economic calculations. You are familiar with the strategy. We now stand on the verge of a new trading week. It is Saturday, December 13th. The financial markets are closed, and the price is fixed at $6.50. This represents a decrease from its peak, pressured by institutional players, yet it still maintains its upward structural integrity. This weekend's apparent tranquility is deceptive. While Western exchanges are dormant, information is disseminating. Engineers in South Korea are conducting complex calculations. Procurement officers in Germany are updating their financial models. Sovereign wealth funds in the Middle East are reviewing the same reports I have just presented. Friday's manufactured price suppression has effectively provided the world with a discount coupon, but this offer expires on Sunday night at precisely 6 o'clock in the evening Eastern Time. In this concluding chapter, I will guide you through the intricacies of the Sunday night market opening. I will explain the arbitrage opportunities facilitated by the Shanghai market, a mechanism that will likely compel a price rebound, and I will impart a final cautionary note concerning the psychological manipulation you are about to encounter. The Samsung catalyst has been detonated, and its shockwave will reach us on Monday. Here is what you should anticipate. When trading commences on Sunday evening, all attention will be directed towards a single metric: the Shanghai Gold Exchange Premium. The SGE serves as the physical barometer of the Asian market. Unlike exchanges in New York, which often function as speculative arenas, the SGE is fundamentally a physical delivery market. Transactions conducted on the SGE typically involve the actual transfer of metal. Currently, a significant discrepancy exists. On Friday, market forces drove the price down to $6.50. However, in China, the premium for physical silver is escalating rapidly, driven by demand from the solar energy sector and recent advancements in battery technology. Silver traded on the ground in Shanghai is currently fetching prices closer to $66 or $67. Do you perceive the inherent opportunity? As a global trader, you observe silver available in New York for $6.50, and simultaneously, you see bids for silver in Shanghai at $67. This presents a risk-free profit margin of $5.50 per ounce. Your logical course of action would be to purchase silver in New York and sell it in Shanghai. This practice is known as arbitrage, and it is the very force that undermines manipulative practices. To capitalize on this profit differential, traders are compelled to acquire contracts on exchanges like the COMEX. This generates substantial buying pressure, forcing prices upward to bridge the gap. I predict that on Sunday night, this arbitrage mechanism will manifest with considerable force. The Asian markets are well informed about the Samsung battery development. They are intimately connected to the supply chain and are privy to the construction of new manufacturing facilities. They view the price reduction in the West as a fortuitous opportunity. Therefore, here is the projected scenario for the market opening. 6 o'clock Eastern Time. The global exchanges open, exhibiting a price gap. Asian trading algorithms detect the disparity in valuations. In response, they flood the market with buy orders, absorbing the inexpensive silver priced at $6.50. The consequence is a rapid upward price surge. The value could instantaneously jump to $63 or $64. Should this occur, Friday's price suppression will be rendered ineffective. The financial institutions that initiated short positions on Friday will find themselves in an unfavorable financial position by Sunday evening. This sets the stage for a secondary short squeeze on Monday morning. The Shanghai arbitrage acts as a market regulator, preventing the West from artificially suppressing prices significantly below their intrinsic value. And with the widespread dissemination of Samsung-related news, that intrinsic value has just become considerably higher. Now it is crucial to prepare you for the psychological battle ahead. The upcoming week will be demanding, not necessarily in terms of price fluctuations, but in terms of emotional resilience. The major financial institutions are aware of their precarious position. They understand that the Samsung narrative is gaining traction and that available silver inventories are dwindling. Consequently, their sole remaining weapon is market volatility. Their objective is to dislodge you from your positions. You will likely witness days where silver experiences a $3 increase, followed by days with a $3 decrease. Their intention is to induce motion sickness, to create such a level of stress while monitoring the charts that you are compelled to hit the sell button simply to achieve peace of mind. Do not succumb to this tactic. Recall the Samsung scenario. Does a $3 price drop alter the fundamental chemistry of a solid-state battery? No. Does a margin rate increase negate the fact that Samsung requires 100 million ounces of silver? No. Does a sensationalized headline on CNBC magically return silver to its subterranean origins? Absolutely not. The underlying economic fundamentals are inelastic. The price volatility is merely ephemeral noise. You must consciously detach yourself from the daily market fluctuations. If you find yourself checking the price every 5 minutes, you are inadvertently playing their game, allowing them to occupy valuable mental real estate. Instead, focus on the premiums being charged. If the spot price declines to $60, but a dealer continues to demand $80, the price drop is illusory. Observe inventory levels. If the spot price decreases, yet out-of-stock notifications persist, the price drop is not reflective of genuine market conditions. The paper price will be strategically employed against you, but the tangible reality of supply and demand will serve as your protective shield. The major financial institutions drove the paper price down to $6.96. Their objective is to persuade you that the recent rally has concluded and that silver is merely a speculative bubble that has now burst. They are disseminating falsehoods. This is not a minor deception. It is an omission of critical information so profound that it borders on criminal negligence. While you were fixated on the COMEX ticker yesterday, and as automated trading systems were executing sell orders for paper contracts in New York, a significant event transpired in South Korea that renders the current price of silver largely irrelevant. An event has occurred that fundamentally alters the chemistry of the global energy transition. Samsung SDI, a preeminent manufacturer of batteries globally, has discreetly confirmed the specifications for its new solid-state production line. Media outlets are heralding this as a battery breakthrough, discussing ranges of 900 miles and charging times of 9 minutes. However, they are overlooking the single most crucial detail. This is the detail that Wall Street has failed to incorporate into its valuations. This is the detail that mining companies have not adequately prepared for. This is the detail that makes a projected deficit of 1.1 billion ounces appear as a mere rounding error. The proprietary component within Samsung's innovative battery is not lithium, nor cobalt, nor nickel. It is silver, and not in negligible quantities. We are witnessing a substantial and structural increase in silver consumption per vehicle. This represents a technological shift that elevates silver from the status of a precious metal to that of a strategic energy commodity. Over the course of this 4-part comprehensive analysis, I will expose the silver bomb that Samsung has just detonated within the global supply chain. I will guide you through the intricate chemistry of the silver-carbon anode. I will perform the calculations that international energy agencies are reluctant to publish, calculations that unequivocally demonstrate the insufficiency of global silver reserves to electrify the vehicle fleet utilizing this technology. Furthermore, I will illustrate why Friday's price decline to $62 was not a market crash, but rather your final opportunity to acquire silver before the automotive industry fully comprehends the magnitude of its critical miscalculation. The financial institutions are engaged in a speculative game played with paper assets. Samsung, conversely, is operating within the realm of fundamental physics. Physics invariably prevails. This is the narrative of the silver-carbon revolution. To comprehend why this development constitutes an extinction-level event for the silver market, consider your smartphone, your laptop, the Tesla Model Y parked in your garage. All currently employ liquid electrolytes and all have encountered limitations. Why? Because they function adequately. Silicon anodes, however, exhibited excessive expansion. Specifically, a silver carbon nanoanode utilizes approximately 15 to 20 grams of silver. This element is integrated into components such as window switches, seat motors, defroster systems, and electronic control units. An electric vehicle consumes a greater quantity, approximately 30 to 50 grams, integrated into inverters and battery systems. For high-performance, long-range battery packs, the silver requirement can range from 0.5 to 1 kilogram per vehicle. Let us adopt a conservative estimate, an extremely conservative one.